Shay Russell here from ABC Bullion, and joining me today is ABC Bullion's Global General Manager, Nick Frappel. Nick, how are you this morning?
Very well, Shay. Good to speak with you.
It's good to speak with you as well. Now, we're going to kick off and get straight into it because we have a lot of topics to cover today. First and foremost, I want to talk about US tapering. Now, this has been quite a topical conversation since the end of the Federal Reserve Bank's most recent meeting. So let's touch on this. And we've sort of delved onto this into our market updates over the past few weeks through the written word. But what's changed in the past couple of weeks? I know you and I have had an off-camera chat sometime last week about how the markets are indecisive right now. So has that changed since we've last spoke?
Well, I think one of the things that's happened is that we've seen pretty reasonable jobs data coming out, and CPI as well. So look, the impression is that tapering should start in September. It doesn't look as though that timetable's been disturbed at all, and the consensus view as well on tightening is probably December at the end of next year. So it looks like we're still on track to carry on, start tapering in September. That's one thing. The other thing is, bond markets certainly haven't overreacted or haven't taken a big view about tapering. They've, if anything, yields have risen, and that's kind of telling us that the bond market thinks that the rate of tightening and the pace of tightening probably isn't that aggressive.
Let's move on a little bit and talk about some of the data that we saw come out of the US. It's been compared to now. Now, we've talked in the past about how inflation in the US is transitory. And this is because, 2020 wasn't a normal year. So I just want to delve into a little bit about some of these high US inflation numbers we're seeing coming out. Now, are you still of the view that this is transitory inflation, or do you think that the genie's out of the bottle, so to speak?
I don't think the genie's out of the bottle, but at the same time, I think there's plenty of time for the genie to step out of the bottle. What I'm reading, at any rate, tends to imply that the transitory argument that the Fed is, employing or believes in, that's still in place. So, for now, that's a sort of a believable thing. One thing that we were talking about earlier was how we've lived in a very, very fortunate time when it comes to inflation. The last 30 years, really, we haven't had inflation at all to speak of, certainly not in the West and not in countries like Japan and so on. Now that we actually have some inflation, it's probably come as more of a shock because very few of us have, there aren't that many people I know at all who've actually worked, and their working life has overlapped with big periods of inflation, because we just haven't had it for since the early 80s, whatever. So I think maybe that's causing a little bit of a reaction. And of course, naturally, when you see something that's relatively new, people are bound to have this argument about transitory or not transitory. At the moment, it's still plausible to believe that it can be transitory. And until that argument, and until that data changes, we can carry on with that view.
So when the data changes, then we'll come back to you and see if you hold the same view.
Absolutely. Yeah.
All right, I want to touch on the US dollar as well. Now, this is following on from our most recent 360 conversation that we had. You put out a little bit of a contrarian view into the marketplace, and you're bullish on the US dollar.
Yes.
And also, too, I noticed in one of your tweets earlier in the week, you commented that the DXY, the dollar index, still has room to make a bit of a rally. Can you explain why you have this view?
Yeah, no, good question. And I'm sort of, it's a view that I sort of have come out with, a few times, came out with at the RIU conference and so on. Look, when the year started, quite a few people were bearish of the dollar, and they had really good reasons to be. So, it wasn't, there were sound and valid reasons to be negative about the dollar, particularly with the amount of debt that was coming out with big fiscal spends and so on. And if you looked at sort of, deficit and dollar behaviors in the past, that it was reasonable to expect weakness. But at the same time, without necessarily being too contrarian about it, there were things that pointed in the other direction. One thing is if you looked at cycle analysis of the dollar, the beginning of the year coincided with a major low that fitted with previous cycles, and I had to kind of respect that and say, well, okay, let's see how this plays out, because the way it ought to play out is that actually 2021 will be a stronger year. The other thing that supported that view was that if you looked at positioning and non-commercial positioning in the DXY, that was telling you that actually people had been reasonably large net short, and that net short was being bought back. It was turning, in fact, to a long. And when that happens, obviously the dollar does rally. But more importantly, it was telling us that whatever analysts thought, money was going in the other direction. And I had to think, okay, well, you follow the money in that respect. What are they doing? Both those things very simplistically suggested that the economic analysis of how the dollar would pan out wouldn't necessarily work out that way. And look, it's been volatile and it's been difficult. But if you were super bearish of the dollar this year and you placed your bets that way, you will have had a very hard time. And I think it's still possible for the dollar to continue strengthening. The last point I'd make about that as well is that with all of the fiscal and monetary support the American economy has had during the last year or so, and sort of ongoing, I expect the U.S. economy to do relatively well this year, and that should encourage assets, encourage money into high-yielding U.S. assets. That should be good for the U.S. dollar. So that's my view in a nutshell, or three nutshells.
No, that's a good view, and it's also not one we're hearing many people say in the marketplace. So you certainly people watching, you definitely heard it here first. Look, we've got a bit of jumping around to do today, and we're going to jump onto the change of Chinese reserve ratio requirements changed earlier in the week. Now, we could put a bit of a bearish tone on this. So does this mean that the Chinese markets are a little bit concerned about a slowdown in the Chinese economy, or are they signaling that they're ready to stimulate the economy a little bit?
I think there's definitely a concern over softening. When the sort of external economies sort of reopened and there was this Q1 kind of reflationary moment, that was good for the Chinese economy, and it sort of implied that the second half of the year would be weaker. Probably the narrative leading up to last week was that it could be significantly weaker, and actually the Chinese economy might have a bit of a tough time of it coming through the second half of the year. That sort of supports why the PBOC has dialed back on the reserve ratio requirement. What we've seen since is that softening does look likely, and if you look at actually PMIs for a lot of Asian economies, they've come down a little bit in the last week or so. So softening, but exports have been pretty good, and some of the other data suggests look, it's actually expect weaker. Don't necessarily expect trouble. So look, it dovetails with a weaker outlook, not necessarily a worryingly weaker outlook. We're going a little bit like tapering. We're going to have to wait for more data.
I like your take there, Nick. We don't need to panic, but we just need to prepare for a softening, especially too. This is valuable information for Australians because our economic fortunes are quite tied to the economic fortunes over in China. So that's great insight there. Now we're going to wrap up with our final question today. Is we need to bring this back to precious metals. Gold's recovered from its when it was stuck around the US $1,700 range.
Yeah.
What are you seeing? But what are you seeing from a managed money point of view? I'm a big fan of following or watching what big money does. So tell me, how are you seeing the so-called longs and shorts playing out in the gold space in particular?
If you look at the most recent data, which goes up to the week ending Tuesday, the 6th of July, what's happened is that the long side of the managed money sector, they've started buying again, and they've added a couple of million ounces, more than a couple of million ounces to their position up to the 6th. The message there is that this is a dip that they're pretty keen to buy. They're happy to buy that dip. What's interesting is that the recent shorts that added in the last month, they've not bought back. Well, certainly they've not bought back, in the week to the 6th. So they're saying, well, this could run further, and I guess that's fair enough because they're letting their profits run. They're sort of saying, okay, until this picture looks different, we're going to remain short. So I think the thing to look at is the just changes in the open interest in the last few days. Now, I didn't have a chance to look at that before our talk, so I was hoping to say something a little bit more insightful on that, but time didn't allow it. I might maybe we can tweet something about that later. But yeah, the shorts happy to let the position run because they entered the market at a good level. Long's looking at it and saying, yeah, this dip is nice to buy, and I think that's a fair point because if you look at technically, if you look at the weekly Ichimoku cloud, the drop in gold found support there. It really didn't go very far below there before re-entering the cloud. At the same time, if you look at short-term behaviors, as the price consolidates and recovers, we're definitely seeing 1820 is a level that's gold struggling at.
Hey, Nick, that is valuable insight about that particular candle there. So thank you very much for that. And obviously coupled with the money we're seeing moved into managed longs is valuable information because it suggests that the bottom's around here, but there's still some resistance for the US dollar gold price to move through.
Yeah, and I guess, that comes back to the point, you said right at the beginning of the conversation about uncertainty and, markets, whether it's, fixed income or whether it's gold being, a little bit of uncertainty about which way these moves are going to play out in the second half of the year.
Look, Nick, we've nearly wrapped up for time today. However, I have to say, I think we should do these video chats a little bit more often. What do you say?
Absolutely. Well, especially with lockdown, it's going to be laptop ahoy, basically.
All right. Well, then I think we're going to need to take advantage of that. Now, Nick, I have been in that trading room. I know how busy it is, so I'm going to let you get back to it. But I just want to say thank you very much for your market insights today, and I will chat to you very soon.
Thank you, Shay. Much appreciated. All the best.